In Australia, one of the most popular choices for an SUV is the Mazda CX-5. It has pretty good reviews and it's a beautiful car. I mean, look at that. Stunning car. So, what is the real cost of buying a Mazda CX-5, especially if you need to do financing to get that car? Very quick disclaimer here, this is obviously not financial advice. This is just me playing with some numbers and trying to get you to think a little bit outside the box. There is a wide variety of models, but I'm going to exaggerate a little bit my point here, just to show you how much a difference it might make to buy a car through financing versus actually using that money to invest on a ETF that buys into the whole stock market. So as you can see, it starts at nearly $31,000. This is Australian, but most models are more expensive than that actually. Let's assume that our model is kind of around $50,000. Let's assume that that's how much the car costs. That's the car that we want, and we need to do some financing to get that car. We also want to extend the financing as much as possible. So if I go here on this online calculator and I write down that I want to borrow $50,000, I want to pay it over a 5-year period, and I'm paying 4% interest rate with monthly payments. I can see that my monthly repayments are going to be $920, nearly $921. The first thing I want to calculate is actually how much I'm going to end up paying for this car. So let's calculate that. We've got $920.83, and we're going to pay this 12 times a year, and we're going to pay that for 5 years. So the total cost of the car went from $50,000 to $55,249, so nearly $55,250. That's the first calculation I'd like to make. So obviously, one possible quick assumption is that the real cost is $55,250. However, I want to spice things a bit here. So I want to consider the possibility of using that money that you would be paying on your financing for the car and invest in the stock market instead. So let's have a look at that. One possible option to do that would be to get the Vanguard High Growth Index Fund. It's available in Australia. It has a 0.29% per annum management fee, and basically, let's have a quick look at what's in it. You basically would be getting Australian shares, you'd be getting international shares, a portion that would be unhedged and a portion that would be hedged. Tiny little bit of bonds here, both international and Australian bonds, and then you get a bit more small companies and emerging markets. So that would be an option. Another option that would bring your management fee a little bit down would be, for example, to have 50-50 in VGS and VAS. So VGS is pretty much whole world except Australia. So this one would have money in the big companies, mainly in the US, because those are pretty big companies over there, but it also has exposure to other countries, as you can see here. And then you would have exposure to Australian shares as well. So as you can see here, some of the big companies in Australia. So either option would be fine, either the one fund option, the high growth, or splitting the money through VGS and VAS. So it's time to use a compound interest calculator. So basically we have $0 in the beginning, but we know that we would be spending $920 or nearly $921 monthly on the payments for the car. With this strategy, we are going instead to put it in one of these funds that I talked about, or the combination of two funds that I've just talked about. Historically, the stock market tends to return 9-10%, but we're going to go with 7.5% here in the hope that this would be a realistic way of accounting for some of the fees, some of the taxes, and even for the possibility that in the short time period that 5 years is, that the returns might not be the same as the historical long-term return. So if we were to do this, we would get to the end of the 5 years with $66,725. So we would transform those $55,000 or those $55,200 into $66,725. Note that of that total amount, more than $11,500 is interest alone. The total difference, in my opinion, between one situation and the other is that in the option in which we buy the fancy new car, we end up a little bit over $55,000 in the negative. In the other option, we end up with $66,725 in the positive. So the real difference is actually, in my opinion, to sum those two values. So let's do that real quick. Let's add the $66,725 here. And we come to the value of $122,000 pretty much, nearly $122,000. So that's the real difference between one situation and the other. I am obviously not taking into consideration all possible scenarios and all variables. I'm just trying to make a point here that perhaps considering only the money that goes towards the car and ignoring that it is an asset that depreciates in value over time might be an incomplete picture. When you buy something that depreciates in value over time, you might want to look at it from the perspective of giving up the potential of long-term expected returns if you were to invest in an asset that grows over time. Now, just to paint a little bit more of a complete picture, I decided to open the PT Victoria website here and see how much it would cost to actually use public transport for the whole year. And the number is a little bit over $1,700. So this would be how much you would pay if you were to use public transport. Now, I would assume that if you were to consider in the car scenario that you would get insurance, maybe some repairs, maybe not many because the car would be new. So insurance and fuel costs, for example, I think you would easily go past that amount over there per year. So I'm ignoring those numbers here in this direct comparison, but if you were to want to consider all the possible values, you would probably want to input those into the equation as well. Obviously, a car has its advantages, public transport has its advantages, and this is not a discussion on which one applies better to your own specific situation. Like I said before, I'm just trying to get you to consider financing an expensive car might have more non-obvious costs long-term than what kind of our brain prepares us to think immediately. There might be a more long-term way of looking at it. I am a very long-term focused investor. So just for fun, let's see what would happen to that difference in final balance between one situation and the other. And we kept investing in the stock market for the long term. So after those 5 years, as we've established, we would have nearly $122,000 difference. So if we go back to that compound calculator, let's just do this to see what happens. What was the exact number? 121,974. 121,974. And then we're not going to invest anymore, ever. We're just going to have that money there. And we're not going to do any regular deposits. But now we're going to see what happens to this money 20 years later. 20 years later, we would have more than $500,000 there, of which nearly $400,000 would be interest alone. And that is the beauty of compound interest. Its consequences become exaggerated over time. It's almost like an exponential growth. If we even increase this number here, we're going to have bigger numbers. We're going to have absolutely crazy amounts of interest alone. The interest is going to be a bigger proportion of the total end value. So I always like to think of investing in decades. So that's why I would like to kind of show what it might represent in the very long term. Thank you so much for watching this video. I hope you took something from it. I'll catch you in the next one. Cheers.